Good evening, everyone. Speaker of the day, Mr. Udayan Choksi, President-elect, Mr. Narayan Pasari, Convener of the Indirect Taxation Committee, Mr. Samir Kapadia, Seniors, ladies and gentlemen, and past presidents. On behalf of the Bombay Chartered Accountants Society, I welcome you all to this very important lecture meeting on Goods and Services Tax Transition Provisions. The dictionary meaning of the word transition is the process or a period of changing from one state or condition to another. As we all know, that GST is indeed going to be a game changer in the way businesses are conducted. Now, whether the change will be smooth or patchy will highly depend on the transition phase, and surely the time will only tell. For successful implementation of GST throughout India, smooth transition provisions are a prerequisite. This will ensure that the new tax regime scores high among the taxpayers and does not affect the ease of doing business. One of the major concerns for business is the availability and eligibility for claiming input tax credit when the current indirect tax regime changes to GST. Any transition to a new law should be impartial for the migrating taxpayers to ensure its smooth acceptability. At the same time, these provisions also leave certain areas of doubt that would throw up certain challenges. In fact, the transition of GST is required across board, be it transition of credits, restructuring of the present business model, transactional restructuring, determining the right pricing, anti-profiteering, filing the last return under the current indirect tax regime, filing the first return under the GST, nature and extent up to which your accounting software needs to be tweaked, and carrying out an impact analysis. A lot of issues and challenges one is going to face. Just to name a few: matching of book credits with the written credits, matching of book stocks with the physical stock if no regular stock taking exercise has been conducted, tax invoices received from vendors not being properly documented, tax invoices not being obtained at all, whether to change the manufacturing location or the principal place of business, whether it is advisable to shut down certain locations or rework the warehousing strategy, whether floating a new entity for separate business verticals, strategizing the stock transfers to avoid working capital blockage, breaking a composite supply into multiple different supplies, merging multiple supplies into a composite supply, determining whether a transaction to be structured as a composite supply or a mixed supply, revisiting the discount policies, reviewing pricing to all related party vendors to avoid disputes in transaction value, able to establish arm's length, and many more. The key to all this maybe is to perform GST impact analysis to understand how GST is going to impact you and your client's business. And last but not the least, training and awareness within the organization and also educating your vendors is a must. To take us through this intricate topic of transition provisions under GST, we have with us Mr. Udayan Choksi. Mr. Udayan is a BSc from the University of Warwick. In addition to his CA degree, he also holds an LLB from Bombay University. Udayan has been working in indirect taxes for over 15 years, serving multinational corporations and India's biggest businesses. Udayan's area of focus is tax optimized supply chains and tax litigation. He has previously worked at a Big Four and prominent law firms in India. Udayan has also spent time in the UK on a secondment to study European VAT. Udayan takes active interest in tax policy initiatives and is a member of the indirect tax committees of prominent professional bodies and business chambers. He is particularly dedicated to development in customs, trade, and transfer pricing, and has also authored representations to the CBEC and the state governments on several tax issues. Udayan has been named in the International Tax Review's listing of indirect tax leaders 2014, 2015, and 2016. And besides that, he always has a smiling face to give solace to his clients. Please join me in welcoming Mr. Udayan Choksi. Before I invite him, may I request Narayan Pasari to offer a memento to him as a mark of our gratitude. . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . Mr. Udayan Choksi.
Good evening, Chetan Bhai, Narayan Bhai, Samir, seniors in the profession, friends. It's a real delight to be with you all here this evening to share what is actually now becoming possibly the most important decision-making point from a GST perspective. We sort of continue to grapple with this uncertainty on whether the July date is real or whether we will actually see that switch over to September. And as we speak today, there's one cabinet meeting happening, and we also have the state finance ministers deciding on the rate. So I think we should have that clarity perhaps by the end of this week. But be that as it may, we for now proceed on the basis that irrespective of when this comes, we'll have to deal with this very important issue of what the transition provisions have. And that's because every time you see an imposition of tax, along with that imposition of tax, we have to deal with a whole new bunch of those tax concepts. When you switch over from one tax to another, you have to recalibrate those concepts. And in the spirit of what we've been seeing in the news, one might say that the GST transition that we'll be doing is the mother of all switchovers of tax that's going to happen. And it's in that the questions that we need to answer just now on the transition side largely deal with the treatment of stock. So for those of us who are in the goods space, we have stocks lying with us, raw material, semi-finished goods, finished goods, lying with us, lying with our supply chain. We have credits. Again, those credits have been under the legacy or under the current laws that we have. And depending on what our status has been, we've taken credits under one or the other legislation, which could be a central or state legislation. And then what happens to our ongoing litigations and our refund claims, because we have potentially money blocked or money which is at risk in terms of what we have. Now, what's very important is that today, while we'll be largely discussing the transition provisions from the CGST perspective, to the extent that the SGST laws are out, so some of them have been passed and are final, some of them are out as bills, including our Maharashtra draft. We are largely going to see sort of parallel provisions in both, and I'm going to highlight to you the points of similarity and the points of difference. And what's very important here is this one point that we've been thinking about, which is that are we going to have state GST laws which are absolutely in sync with the central GST laws? And what we are seeing is that pretty much so far that is the case, and especially on this important issue of transition. There are a few nuances in terms of the fact that the state law ultimately replaces largely VAT and entry taxes and so on, whereas the central law replaces excise and service tax. So to that extent, we see some differences between the state and the central law, but it's actually very important to notice the fact that for the most part, the drafting of the CGST legislation is verbatim with the drafting of the state laws as they've come. Now, this is important because among you and among our clients, they are going to approach these transition provisions from different perspectives. So when you think of yourself as a manufacturer, for example, you've largely been dealing with the excise principles, the excise concepts, and the credit provisions which deal with those concepts. You also wear a second hat when it comes to state taxation in terms of your VAT liability. And therefore, when you look at how the transition provisions are going to apply to you, as you go through each of the sections, which we will together today, you have to consider that this provision is going to apply to different provision to different persons given their different perspective, and it's actually the same provision. So very rarely do we see a provision which says that this pertains only to service providers or this pertains only to manufacturers or traders. Rather, the way the drafting of the law has been is that it deals with taxes or it deals with situations, and you actually see for the first time that even a CGST law incorporates a lot of elements of that, because you will now have, for example, if you take this issue of stock, you are going to have traders who didn't take excise credit till yesterday because they were only in the trading space. They may or may not have been first stage or second stage registered dealers. But tomorrow on the stock that they're holding in hand, they are going to need to get excise credit. So we actually see, apart from the fact that you're going to look at multiple perspectives, you're going to see this element of overlap which has been built into the transition provisions, which is very important. The other key takeaway that sort of struck us as we were going through the provisions is that a balancing act has been sought to be achieved between enabling credit and saying that there should be no P&L hit as such, apart from the fact of what we've been hearing in terms of our sales going to dip in the quarter as people take decisions on how much stocks to hold, and we'll come to those the reasons behind those sort of decisions as we go along. But really, it's been a balancing between enabling credit and making sure that there's no P&L hit, and at the same time putting safeguards and checks and balances in place to make sure that perhaps there's no incorrect availment of credit. Thank you. Incorrect availment of credit that's going to be enabled through the transition provisions. So as we go through these, I would sort of urge you to, in your mind, please keep looking at those different perspectives and looking at these balances, because you will see all of those play out in all of these sections. So before we get into the deeper provisions, we are really dealing with only 4 sections, some of the subsections are quite small but very, very impactful in terms of what they're going to mean for how business gets done, and some of them are largely to do with, the procedure of how the migration is going to take place. So the first section in relation to transition is about migration of existing taxpayers. And the provision is that if you have a registration under any of the current indirect tax laws, which basically would mean excise or service tax from the central point of view, and VAT typically from the state point of view, and you have a PAN, then you will get a provisional registration. Now, we have been for the last few months dealing with migration, and I don't know how many of you would have thought of this question of which provision are we actually registering under. And if you actually go to see, all of what we've done on the migration so far is absent any provision of law. So there's nothing in the VAT Act which asks you to migrate. And there's nothing actually in the GST law which has kicked in so far which makes that migration happen. So this is actually the provision under which your migration is going to happen. And you already made several steps in that journey in terms of getting a provisional GSTINs and so on. So the first step for those of us who are migrating, as opposed to those of us who will be new assessees, is that you will get your registration on a provisional basis, and then you will have a 3-month time window to submit the necessary forms and the backup documents so that your registration becomes permanent. Now, should you not do so, the consequence of that is your registration is liable to be cancelled. And while that might not seem so bad per se, the immediate consequence of that, of course, is that you cease to be a registered person, and therefore all of the credit and other provisions which deal with registered persons would cease to apply to you. So actually being registered and staying registered is going to be important. The second, of course, is that there is a way out which is provided for under section 139, which states that should somebody decide that they don't want to proceed with this registration, even though they might be registered today and holding a PAN card, then there's a form that they need to file. And on the basis of that form, they will be allowed to sort of exit from the registration provision under GST. So this is the section under which all of us will move over basically from our excise registrations to the GST registrations. Now, in the form that we applied for, you would have seen that we were noting all of our places of business. And therefore, especially from an excise concept, and I think that's where the largest change gets marked, which is that as a manufacturer, each of your excise locations were separate taxpayers effectively. And now you move to a situation where you will basically agglomerate all of those excise units into one registration for the state. On the other hand, of course, we have a decentralization happening for, let's say, a typical service provider who might have been centralized and now moves from a central to a multi-state footprint of his taxes. So we have pretty much, we've referred to 7 of the state VAT legislation, state GST legislations, which you see at the bottom there. And section 139 is pretty much copied verbatim into the SGST laws. And what that therefore means is that pretty much the same test will be applied. In fact, it's the same registration. You're not separately registered for SGST and CGST. So the reason of having that single common legislation in wording in the legislation is that ultimately it's one legislation, even though it's going to apply under 2 acts when you take one state at a time. We then move to section 140, which is really the most important section, if I may say so, which is dealing with SENVAT credit or VAT credit, the basically the carry forward of credits. And what this section contemplates, and it goes through various different fact profiles, is the manner in which credit may or may not be taken when one moves over from the current tax footprint into GST. So section 141 deals with the typical situation of a registered taxpayer today who is liable for taxes. So what the section says is that a registered person, not one who is going to go for composition, because as you know, the composition scheme disallows any availment of credit. So if you're going to be a registered taxpayer paying tax in the regular course under GST, you can get credit of all the tax which is reported in the last return that you file. So the return that you will file for the period ending 30th June, presuming that we go live on 1st July, that's the credit that you get to take forward. Now, this is where we therefore look back. Let me go back to my point about excise, saying if you had multiple plants, each of those plants would have filed an ER1 which would have had a closing amount of SENVAT. You will actually have the total of that SENVAT amount which will get carried forward for that entity at the state level. So this is really about saying that it's not actually facilitating availment as such. It's saying that credit which you've already availed, which today is SENVAT credit, and again you have a similar provision under the state law, so there we'll be talking about VAT credit, will actually, like you move over from being a manufacturer or service provider to being a supplier, these credits will move with you and now become CGST and SGST credits. Now there are certain conditions which need to be run through. So the credit should be eligible. The credit which you've already taken validly under the SENVAT or VAT provisions should be admissible under input tax even under the new provisions. And now, as we know, there's much more liberal provisions for availment of credit under GST. You should have filed not just the last return for June, but the last 6 returns. So there is, I'm guessing they're going to want to see the flow of credits that you would have reported month on month, or whether there'd been an accumulation or not. And like I said, this is possibly the first example of that checks and balances, where they're not just going to accept what you report as the cutover date SENVAT credit, but also look at the credit that you reported for the last 6 months. And of course, the credit should not relate to exempt goods manufactured. Now, in addition to these 3 conditions which are there in the CGST legislation, there's one very important additional condition which is there in the SGST legislation. Now, what that states is that if you have made any sales which didn't accrue income to that state, and there are 5 examples, 5 illustrations which are listed in the Act itself. So it talks about interstate sales, because that would be the E1, E2 actually, or penultimate sales for export, which are exempt, CST sales, stock transfers, or SEZ sales. So in respect of these sales or these stock movements, where you wouldn't have had a tax liability in your origin state, you need to file the forms, and that's your C form, F form, I form, H form. You need to file those forms within a period of 3 months for the credit to be made available to you, failing which you could have some clawback in terms of how much credit you can actually migrate over. So basically what they're saying is that you've taken the benefit, you've availed credit validly, you've taken the benefit that this tax is not going to accrue to your origin state. In any case, under the CST law, you're supposed to file these forms within 1 quarter, and basically they're asking you to fulfill that compliance requirement, failing which they're going to restrict how much credit they actually allow you to take over, because you've taken full credit, barring of course what the provisions of reversal currently are. Now, a question has arisen in terms of whether this is going to pertain to credits only of the current year, or might it pertain to uncollected C forms and F forms of earlier years as well? And obviously that would be a big concern for all of us, because the quantum involved for several of us and our clients would be quite large. It appears from the language of the section that if we are talking about migrating credits that have been taken, it ought to pertain only to the current financial year, because that's the credit which is being rolled over, because your other credits as of 31st March would have formed part of your last year's return, and they will get assessed in the normal course. Now, continuing with the state provision, it also says that if for any reason you can't migrate the credit because those forms are not available. Should you subsequently able to evidence the validity of those transactions by collection of those forms, then that amount will come back to you as a refund, not as way of credit. Now, one might look at this even as an opportunity, saying, would you rather have the credit migrated over, or would you rather collect the forms later and get in cash? Again, that might be a decision to be taken. This amount of credit, so now we go back to the larger across state and service credit. The amount of credit that you're going to be carried forward goes into your electronic credit ledger. That's the new system of taxation that we have. And as we said before, multiple registrations will be merging. So your VAT and your excise and your multiple excise and your service tax, all of those merge as far as the transition of credit is concerned. So this at the manufacturer or service provider level or the trader level, if we are dealing with the VAT provision, because like I said, this same provision applies across the central law and the state laws, is going to be critical for the company itself or the vendor itself. We'll come to the separate provision where it deals with the larger ecosystem of that company. So let's say a company who is a manufacturer. So we talked about the SENVAT credit they have, the VAT credit that they have in terms of raw materials, semi-finished goods and finished goods. When it comes to the goods which have cleared the factory and are lying at different levels of the supply chain, we'll come to that later. So 141 deals with that entity itself. Continuing with the SENVAT theme, 142 covers for the situation of unavailed SENVAT credit on capital goods. Now, as we know, under the SENVAT credit provisions, you don't get all of the SENVAT credit upfront. You have to take up to 50% in the first year and then the balance in a subsequent year. And therefore, again, a registered person who is not in composition, the same test that we have, is entitled to take credit of unavailed SENVAT credit on capital goods. So notice the difference between 141 and 142. 141 dealt with credit availed, which is sitting on your RG register. We are now here dealing with the situation of credit not yet been availed because the event for availment of credit may not have come. So this could come in two situations. It could come where your capital asset has been bought in the current year itself, which means you would have taken the first 50%, the second 50% event would not have arisen. Or it could be a situation where in a past period you did take 50% or less, but you had some unavailed credit which you were for whatever reason yet to take. So these two situations will get covered here. Now, again, the same conditions as we saw in 141, which is that the credit should be admissible under the existing law and it should be admissible under the new law. So that's the test, the twin test in terms of continued availability of credit. Again, here the credit will be taken in the electronic credit ledger. And here again, we have the same provision even under the state law. So to the extent that you have any VAT payments pertaining to those capital goods, which for whatever reason you may not have availed, they will migrate over in the same way. To be noted here in 141 and 142 are both dealing with actual SENVAT provision. So we have not come to the larger cross-functional utilization yet, which is in fact what we come to in 143, which is possibly the most interesting and complex provision in terms of different business situations that it deals with. So it deals with a registered person, and we have now listed down the examples which are there in the law itself, and we've broken them up because each one of them actually has a slightly different implication. So it starts with, I'll just run through the list. Persons not liable to register under the current law, or persons engaged wholly in the manufacture of exempt goods and services. Providers of works contract services availing the abatement benefit and therefore not eligible for credit on inputs. And then first stage dealers, second stage dealers, registered importers or depots. Now what's common in a sense to these four different categories, if I may call them so, is that in some way they were not eligible necessarily for the entirety of credit under the current law. So let's take for example, and we've compiled a couple of the examples. I don't know if you all can read them at the back, so let me just run through the list. Who is not eligible to register under the current law? Let's take a few examples. So you could have a manufacturer who is below the SSI threshold and therefore while a manufacturer is not actually part of the SENVAT system. Or you could have a trader who is currently below the threshold limit. remember, under the e-commerce, irrespective of your threshold limit, you're going to become a registered person, and therefore that could be an important segment of people. Or you could have a trader vis-a-vis central excise duty. So not a first stage dealer or a second stage dealer, which means you're dealing in excisable goods, but you don't issue excise invoices. So for you, the excise element in those invoices sits as part of cost. Or you could be a service provider like us, chartered accountants and lawyers, vis-a-vis the VAT that we pay. So all of us pay VAT on goods that we consume. Today, that's not creditable to us. And then there are two other examples which we saw in one of the places. Supplies of goods which are currently taxed to the first point of sale, like medicines in some states under the VAT law, where you don't get credit because you pay the upfront VAT. And then the last, where you get ITC only at the time of sale, so you don't actually book ITC before. So all of these situations are pertaining to people who either don't need to register or have made business decisions which don't require them to register. Now, they are holding goods which they bought by paying the current set of duties, which could be an excise duty and a VAT. And again, they could be manufacturers and service providers and traders. And they're going to make taxable supplies either of these goods or using these goods. And therefore, what 143 does is enable those sets of credits. So this is the section under which, for example, a service provider is going to get credit of VAT, or a trader is going to get credit of excise, just to put it into that perspective. Your situation of B was somebody who is wholly exempt. And again, if you're providing wholly exempt goods or services, you don't get SENVAT credit. That's the provision under the SENVAT credit rules. Likewise, if you're a works contract provider and you're availing the benefit of 26 of 12, you don't get input credit. You get input service and capital credits, but not input credit because you're choosing the abatement. And then, of course, a slightly different take insofar as first stage dealers, second stage dealers, and registered importers and depots are concerned, because they actually are still part of the full-fledged excise chain, because they are actually either taking credit of duty paid on a bill of entry or against an excise invoice. So all of these people, A to G, this list, are eligible to take credit of duties held in stock, whether of raw materials or semi-finished goods or finished goods. So this is the critical issue, that you are now going to get credit of taxes that you paid, which potentially you were not eligible to take, because if you were eligible to take them, you might have taken them under 141. So these are credits which you've not taken, given your business facts and circumstances or some decisions that you've made. Now, the credit availment under 143 is subject to the following conditions. So you should use these inputs. Mind you, 143 deals only with inputs, and therefore it has a very SENVAT flavor to it, because it doesn't deal with input services, it deals only with input. So the inputs are to be used for making taxable supplies, again, which could be supplies of goods or supplies of services. So even a service provider or a trader would be part of this. The registered person is eligible for credit under the new law. You're in possession of an invoice evidencing payment of duty. Now, this is important. If a trader is holding an invoice which evidences that he is holding goods, a commercial invoice as opposed to an excise invoice, we may all know that there's an excise element embedded in that commercial invoice which he is holding, but that would not fulfill the requirement of saying that he is holding a document evidencing payment of duty. So just showing nexus may not suffice. You actually need a duty paying document. So what we for Rule 9 purposes in SENVAT say a duty paying document, something like that, is going to be what you need to take this credit over. And of course, you shouldn't be taking any abatement. Now, what also struck me when I read this provision on abatement is that it looks like, in addition to the multiple rates in service tax that we've discussed, possibly we're going to have an abatement also, because they seem to have, they've mentioned that there could be abatement. So in so far as the complexity of our current tax, we thought that perhaps with the migration over, we won't have the various abatements of service tax, but we might. Now, therefore, what we are saying is, if you fulfill these 5 conditions, even if you were not eligible to take credit under the current law, but you are going to be a taxpayer under GST, and this is valid credit if you would have made the purchase of these goods today, because that's what that provision 2 says, that it's eligible credit today and you're using it for taxable supplies tomorrow, you will be able to take that credit. So what's going to drive that decision of whether credit becomes available to you or not is going to be the fact of whether you have an original document evidencing that payment of duty. And that's going to be the heart of all the supply chain decisions or the reorganizations that get done in terms of planning the transition. Because if you don't have this tax-paying document, you're going to have to fall back to what the proviso allows. So what that says is that a registered person and not a manufacturer or supplier. And now it seems to me that they've excluded manufacturer and service provider here because a manufacturer and service provider ought to have a duty paying document because he was part of the SENVAT chain. So a registered person other than these two, so clearly a trader, and let's use the trader as our standard example. A trader who is not in possession of an invoice or a document evidencing payment of duty can take credit, but not the whole credit. So a trader in the example that we took earlier can only get 40% or credit to the extent of 40% of the output tax, the output GST. So this is again quite important. It's not 40% of the embedded tax that he would have paid, because actually while we might be able to back calculate it, there is no duty paying document evidencing how much duty he paid, and therefore this is almost like an assumed duty credit that's being given to you. So it's 40% of your output tax liability when you make your taxable supply. And this is where you see that depending on where your goods fall or your services fall, the implication of how much credit you will be able to claw back through 143 is going to be a function of what your output rate of tax is. And therefore, when you compare, and we were doing some mathematical iterations, across some industries like cement, I think has been one of the typical ones, it's arguable whether you're better off or worse off taking the proviso, because you're going to get, let's say you're on 28%, which typically is what cement is expecting them that they will be at. Then you're going to get 40% of 28%. Today, the tax you would have paid is 12%, 12.5%. So it's not as simple as saying, I'm not going to get full credit, I'm going to get part credit. But it's actually a function of how much of that input goes into, let's say, what you do. Are you a trader? Are you a manufacturer? Are you a service provider? What's your output tax rate going to be? And what supply chain decisions are you going to make? So let's extend this principle, because like I said, the maximum amount of thought and planning has gone possibly behind 143. So let's take our typical manufacturer FMCG type company. The FMCG company itself will be taking credit under 141. So that will be a migration of the current credit. But let's say goods which have been cleared from its factory, would be lying somewhere in the value chain which is downstream. So it could be lying, let's say, at a mother warehouse. The mother warehouse is still part of the same company. It could be lying at a CFA, again still part of the same company. Or it could have been sold by one of these to a distributor or a dealer, or depending on what sort of supply chain they follow to get the goods out into the market. The challenge is going to be in terms of deciding the feasibility of whether or not it might be possible to reverse the movement of goods back to the last duty paying location if you want to migrate the full credit. So let me explain what I mean by that. Let's say we have a very simple supply chain. From the factory, the goods go to a CFA, and from the CFA, they go to a customer. Let's say it's largely a B2B business, because we keep things simple. If the goods have gone to the CFA will have the excise invoice, because when the goods cleared the factory, that would be under cover of an excise invoice. So while the CFA may not have been issuing excise invoices itself, the CFA has a duty paying document which allows it to get credit. So far so good. Goods therefore lying at the CFA location, or it could be a distributor, whatever, mother warehouse location, are fine. When you go one step down, but where the CFA might have sold, let's say, to a distributor, and then you have, let's say, one more level before it gets to customer like a dealer, the goods now lying with the distributor either need to come back and get reissued under GST, or the distributor is going to have a reduction in how much credits available under this 40% rule that I explained to you. And therefore, this is the decision that we are taking across clients, and this is the decision that companies have to make, and this is the decisions that as advisors we have to help them with in terms of deciding the best course of action, where you have to marry what's tax efficient and also what's logistically feasible. Because For example, we were talking to one person who said, if I were to vacate my downstream vendor go downs to bring my goods back, somebody else is going to send the goods over there. And once that vendor space is blocked in the downstream supply chain, that place is lost to me. So it's not just about how much tax we can save. This decision is going to be, yes, about how much tax we can save. It's also going to be about the feasibility of moving goods back. It's also going to be about potentially sometimes competitive positions. And when we talk about competitive positions, we might also find that if there is going to be a hit, let's presume that there's going to be a hit for somebody downstream, that there is going to be a dealer in the value chain that I just described, where somebody is going to lose credit because the SENVAT chain has currently been broken. It might be the prudent business decision to actually make good that loss, share it or make it good in full, and work out a commercial arrangement by which you don't disturb your supply chain. So again, like I said, this is where multiple things are playing out. The government has been benevolent, or the Parliament and law has been benevolent enough to give us credit. It's given us credit under an assumed formula. That assumed formula is going to play out for different people in different ways. And given their business realities might be a complex mix of all of these elements that I mentioned, this decision actually is going to have to weigh all of those and then come to what the right answer is. So just to recap, that credit is restricted to 40% of the CST that's going to be paid on those goods. More importantly, you don't get that credit as benefit to that person itself. The benefit of that credit needs to be passed on as a price reduction downstream. So that further complicates how the calculation of the cost benefit of this is going to be. The FAQ and the Act also provides that the methodology of calculation is going to actually be prescribed. So while we know about the 40% yet, we'll have to see what else comes into the prescription of these rules. Secondly, this credit is also, because of how it's linked and the fact that it needs to be passed on for the credit to become available, also requires that you won't get that credit upfront, but that credit will be spread over a period of 6 months, where at the end of each of the first 6 months after the switchover, you will have to report the extent to which you've made such transactions, report the extent to which you have reduced the price of those goods, and then your quantum of credit will actually crystallize. So that's how this section is going to play out. We then move to 144, which is actually a combination of the provisions of 141 and 143. Now, 144 deals with a registered person, our typical Rule 6 of SENVAT type of person, where you're a manufacturer of exempt and taxable goods or a provider of exempt and taxable services. What that says is that to the extent that you have carry forward of credit validly taken under Section 141. So basically, as a provider of taxable services, partly taxable services, and as a manufacturer of partly exempt goods, you would be filing your returns. On those returns, you would have reported a certain carry forward of credit. That carry forward of credit is eligible for continuation into GST, just like 141. And to the extent that you have other inputs on which credit may not have been available, you apply the provisions of 143, the provisions that we just discussed. So this is, really speaking, just a combination of what we have, because it's actually a combination status. So the the status of one was a manufacturer service provider typical case. The 3 was a downstream mix of those examples. 4 deals actually with somebody who's actually wearing both those hats. Again, yeah. Okay, we've been asked to take questions later, but I'll come back to you. We then come to 145. 145 deals with a situation where the credit pertains to eligible duties and taxes on inputs and input services where they have been received on or after the appointed date, but the tax on that supply has been paid by the supplier under the current law. So an invoice has been raised today, tax has been paid today by the vendor, but that invoice has not been received by the buyer, and therefore the tax has not been, credit of that tax has not been taken today. So that could be two sorts of situations, which colloquially we are calling either goods in transit or services in transit, where your clearance event or your tax event at the supplier end has happened, but the receipt event has not happened. Here what it says is that the invoice or other duty paying document must be recorded by the buyer within 30 days of the appointed day, subject to a further extension of 30 days that may be allowed. A statement needs to be furnished of credit which has been taken under this rule. And like we said, the same provision exists under the State Act. That's fine. There were two other points to make here. This section does not enable carry forward of credits that we have missed to take or forgotten to take. So credits that you ought to have taken under 141 in your return, which you missed to take, are not enabled by 145. So 145 only talks about situations where the payment has been made before, but the receipt of invoice has taken place after. It doesn't deal with situations where the invoice was lying with you, but you didn't take the credit. So what's in a sense even more important than the enabling part of 145 is the disabling part of what it implies, which is that if we have carry forward of invoices which we have not booked into our SENVAT account or our VAT account, we could potentially lose that credit. Now, the definition under 140 has different sets of applicable duties. So the eligible duties for 5, which we have to contrast from what we had in 3, 4, and 6. So 3, 4, and 6, because we were dealing with inputs as we discussed, were all of the duties that are currently eligible duties under the SENVAT credit rules. 5 talks about all of those duties, so all of the various excise duties, the CVD, SAD, and so on, and also service tax, because 5 also deals with a situation of services in transit. So if you were to sort of step back and look at how 3, 4, well, 1 to 5 add up, at 1 you started with carry forward of credit, 2 dealt with credit eligible but not taken, 3 dealt with credit which was strictly not eligible but now is being enabled because you're holding goods which will become taxable tomorrow, 4 was a combination, and 5 deals with goods and services in transit. What you actually find is that the only place you're allowed to take credit is where there's an evidentiary trail of the validity of the transaction. So wherever goods are involved, they've asked you to show the invoice and take credit on the basis of that invoice. Where services are involved, you couldn't get credit under any of the provisions except 5, where you actually have the invoice coming to you in a GST regime. So that's the subtle difference between how they've treated goods and treated services. They are allowing you more easily to carry over credit pertaining to goods because that trail is more evident, as opposed to services where there is no trail at all. We then come to 146. 146 deals with people switching over from a composition scheme under the current law to a full tax status under the GST law. So the language, of course, is very excise driven here. It talks about tax being paid at a fixed rate or a fixed amount of tax, fixed amount in lieu of the tax being payable. Again, you're eligible for inputs held on stock and inputs held in semi-finished goods. So this is again dealing only with inputs. This is the point I was making earlier. So subsections 3, 4, and 6 deal only with inputs. 5 dealt with inputs and input services. So 146 in its language is very similar to 141. 141 dealt with somebody taking credit and running the business. 146 is exactly the same person, but currently he was under a composition scheme who is now going to become a fully taxable person. So the conditions that you see for availment of credit are very similar to what you have under 141. So the inputs should be goods intended for making taxable supplies. You should not be under composition. They should be eligible under the current law. You should be holding the document in your hand, and those documents should be less than 12 months from the switchover date. So pretty much exactly the same provisions as we had in 141. 141 didn't talk about composition. Here, of course, composition is mentioned because it's about people from composition moving out of composition. So 1 to 6 dealt with the goods part. 7 onwards deals more on transition of service related provisions. So both VAT and service tax, 1 to 6 so far, all of them while we, like I said, discussed the central GST provisions, have almost identical, if not identical, provisions under the state law. The only place where there was a change I already mentioned to you, which was about the form collection in terms of transition of the credit under 143. Now, 147 talks about credit distribution by an ISD, and it says that input credit of any services received prior but invoiced after the appointed date are eligible to be carried forward. And I was just thinking of what might be a good example of that, and perhaps audit fees is the best example, where it's at the culmination of the work that the bill gets raised. So the service might actually have been provided, but the invoice has not been issued. And therefore, for the services that we provide, and I guess audit might be topical even the time of year we are at now. So if you raise your bill for your audit services after we've switched over to GST, that credit will also become eligible. The ISD will be able to distribute it. There's no provision of this nature in the state law because of the obvious fact that there is no ISD concept under VAT. We then come to centralized registration, again linked to service tax. And it says that a registered person who is centrally registered under the current law and who continues to be registered under GST can take credit of the last amount booked in the return. So this is the 141 or the 143 playing out for a centrally registered service provider. Now, credit needs to be admissible also under the new law, and that's something which we've seen consistently, that for credit to be eligible under GST, it should have been validly taken under the existing law, and it should be validly taken under GST as well. You need to file a return within 3 months of the appointed date reporting this amount of credit that's being taken. It could be an original return, or, and this was a peculiar provision, that you could even file a revised return if the credit has been reduced from the credit that you claimed earlier. So basically, you will not be allowed to enhance your credit in a revised return when you go under the ISD. The important part here is that unlike our current provisions on ISD, which dictate under Rule 7 how credit gets distributed, which is in the ratio of the turnover of the different units, and then of course we've had that transition from own units to not own units and now back to own units. 148 allows you to pass on credit to whichever of the units that you want to pass on that. So this is a one-time only type opportunity if in a particular set of business circumstances this might become relevant, that you get to choose which of the states you want to pass the credit to. So if you have a service, I mean, you will have an ISD for a service provider would basically mean a situation where perhaps you have multiple states. You may or may not have an equal footprint of output service tax liability. In fact, that itself is a huge issue, the whole issue of place of supply, which is going to come up in the context of GST and how people are going to deal with multiple places of supply when you have centrally procured services. So we actually have to telescope those provisions or those sets of concepts under how place of supply is going to work with where we might want to park this centrally procured credit. Because like I said, there's a one-time only opportunity to move it to the state that we want to. The last subsection under 140 is 149, which deals with reversal of credit which might have been made under the proviso to 47, which says that, of course, if you've taken CENVAT credit of an input service on the strength of an invoice and you've not made the payment against that for 3 months, then of course that's eligible to be reversed. If that reversal happens, CENVAT credit for the reversal can be claimed under GST within a period of 3 months. So any of those unpaid invoices where a reversal has taken place, you have 3 further months after the switchover date. So basically an extension of that 3 months to actually make that payment and take the credit. 140.10, just touch upon it briefly. It says that the credit under 3, 4 and 6, that's the ones I was talking about, which deals with inputs, shall be calculated in a manner as may be prescribed. There are draft rules which you've seen. In fact, it's the draft rule under which that 40% credit restriction comes through. But as I said, it's quite complicated in terms of how that rule is going to play out. And I was reading one article which very nicely highlighted that if you consider the fact that you're going to have to make a price reduction to the extent of credit that you're going to avail, that's going to change your assessable value for the tax itself. So you're going to actually have to do a goal seek to come to what is that balance between how much reversal you need to do to arrive at that price. But that's, I mean, that's, let's say that's our approach in terms of how we might calculate that. We'll actually have to see specifically on that provision what the law provides in terms of how that's going to happen. And in a sense, this may link to what we've been seeing about anti-profiteering. So possibly this reason for saying that you need to pass on the credit to get the credit is that that leaves you revenue neutral, because in today's supply chain as a trader, you didn't get excise credit. So that excise formed part of your cost. And the principle seems to be, if tomorrow a part of that excise credits become available to you, you shouldn't profit from that excise, pass that on to your customer as well. So there's that element of anti-profiteering which is coming through possibly here as well. Like I said, that's a much larger business decision to be taken in terms of passing or not passing, or how that credit's going to work. But we will have to wait and see specifically on this what further rules come in terms of how the credit calculation takes place. Again, we have the same provisions under the SGST Act. That's because, as I said, all of these provisions not only transition SENVAT credit but also VAT ITC. So that was 140, which dealt with the transformation of credits from the current regime into GST. We then go to 141. 141 deals with job work and job work type situations. So as we know, there are specific rules under the excise law which enable, under different situations, goods to be sent out with or without payment of duty. So that's rules, basically rules 16A, 16B and 16C of the Central Excise Rules 2002. So under 16A, which is your classic job work case, inputs either as such or as semi-finished goods may be cleared for processing, testing, reconditioning, etc. And those goods typically come back within 180 days, and there's no change in the credit. Semi-finished goods, that's under 16B, which may go to any other premises for carrying out further manufacturing processes. And then we have excisable goods under 16C, which may go out for testing purposes. That's of course subject to, well, rather not subject to, follows the 2006 amendment in terms of how a 16C, even other than for manufacture, goods can be cleared, which was enabled under 16C from 2006. Now, what 141 says is that if you have moved these goods under any of these circumstances, either inputs or semi-finished goods or excisable goods for testing, which are lying with your job worker or processor or whoever, those goods need to come back 6 months from the appointed date. So again, like for our 4/7, we had 3 more months to pay our service tax to get the credit. Here, you anyway had 6 months. Here you're given a further period of 6 months for the appointed date for the goods to come back. Failing which, and this is where there's a double whammy, failing which, input tax credit will be recovered. The input tax credit that you would have originally taken would be recovered from you under 142(8), which is the provision for recovery. Also, please see the second line where we said no tax shall be payable if the goods are returned within 6 months. So if 6 month trips over, your job worker or your processor will be liable for output tax when he returns the goods to you or clears the goods out, as well as you will lose the credit that you paid when you procured the goods earlier before you sent them to him. So we need to be doubly careful here, because this is the one provision where there's a double whammy in terms of both credit loss as well as an output tax liability getting generated. So 141, 2 and 3, we've clubbed them together because largely the provisions are dealing with the same situation. Again, there's a fine difference between 16 ABC as we just discussed. So there are some more conditions in terms of semi-finished goods and excisable goods. So out of the 3 situations that we discussed, inputs need to come back. For semi-finished goods and excisable goods, under the provisions of 16B and C, which have been continued even under the GST provision, you can transfer those goods to other premises on payment of tax, or you can export those goods without payment of tax. So that's an extra provision beyond what 16A allows. So that's also been separately enabled over here. A statement needs to be filed in terms of what these credits are. And again, we have the same provisions even under the state acts. Okay. We then come to 142. Now 140, so again to recap and just see the architecture of how they've set out the provisions. In 140, we dealt with the migration of tax credits. In 142, we deal with the migration of situations. So those situations could deal with your demands, it could deal with your refunds, or it could deal with your day-to-day undertaking of your business, your contracts which you've entered into, which are yet to be fulfilled, and so on. And there's this variety of 10 or 12, I think 12 subsections which 142 covers in terms of those different fact situations. So 142.1 deals with returns, sales returns of goods, sort of picks up from what the current VAT provisions are, and says that if goods on which duty has been paid under the existing law are returned after the appointed date, that doesn't constitute a supply if those goods come back within 6 months from the appointed date. Mind you, the goods also need to have been sold only within the last 6 months prior to the switchover. So if the sale was prior to that, you don't get the benefit of this provision. Now, here the provision makes a distinction between goods being returned by a registered person and goods being returned by an unregistered person. If goods are returned by an unregistered person, you are eligible for a refund of the tax paid, subject to you being able to prove the identity of those goods. So what we are saying here is, in the last 6 months I've sold these goods. Within 6 months after the switchover, the goods have come back, and they've come back from a person who is not registered under GST. And therefore, I'm going to get a refund of that tax, because the tax which was paid was the earlier tax. It was VAT. Now, if it's a registered person, on the other hand, they haven't gone for the refund provision. What they've said is that the other person's registered. That credit would have migrated over to him under a 141 type situation. And therefore, when he returns those goods to you, let's treat that return of goods to be a supply. So there's a marked difference between the treatment of a sale return from an unregistered person and a registered person, wherein one is eligible for refund and the other one is treated as being a taxable supply. Again, we have the same provisions also under the SGST Acts that we've seen. Then we come to a situation where we have a price revision. Now, mind you, all the situations in 142 deal with periods where your transaction straddles the switchover date. So part of the transaction has happened before and part of the transaction is happening after. And therefore, these situations in terms of either some blockage of credit or some loss of tax is going to arise. So in the first case, if you had that sale return, you needed to make good the tax which you would have unnecessarily paid before, which is why they refunded it to you or said that he takes credit and gives it to you back as a taxable supply. Now, if you have a revision in price, it says that in pursuance of a contract which you entered into before, if the price of those goods or services goes up in GST, you have to issue, and this goes back to what we have under the invoicing provisions, issue a supplementary invoice or a debit note, which again will have all of the compliances in terms of what that document needs to contain for valid availment of credit and so on. And if it's revised downward, a credit note. That needs to be issued within 30 days. And to the extent of this modification which is being made to the transaction is deemed to be a supply taking place under GST. So I could have said that I'm going to sell certain goods. So let's put some numbers to this. I could have said that I'm going to sell certain goods or provide certain services for X value. That tax would have been discharged under the earlier provision of law. If that X goes to X plus or X minus, that delta is a supply under GST. So that X plus will attract GST and the X minus again will be treated as a reduction of my value. Because it's treated as a reduction of value, as you know, for under the GST and matching provisions, my reduction in value will only get validated if that credit note is also uploaded by my counterparty, by my customer, and he reduces the credit which of the tax originally taken by him. Because again, you can't have a situation where he's taking credit of the original amount of tax and I'm reducing my output tax liability. So this actually is treated as a transaction which takes place under GST. Again, we have the same provisions applying under the SGST Act as well. Then we come to the three sections subsections dealing with our pending refunds. So the first one, which is the omnibus provision, says that if you have filed a claim for refund under the current law for any, If you filed a claim before, on, or after, this is the provision which actually covers all three situations, which is why I said it's the omnibus provision. If you filed a claim at any time for, and they've listed what it's for, SENVAT credit, duty, tax, interest, or other amount which was paid under the existing law. So you could have filed the claim at any time. It will be disposed of in accordance with the old law. And this is a theme which we will see recurring across the refund provisions, that if a refund is being given to you, the disposal will be under the old law. If a demand is being made from you, the demand is going to be under the GST law. So this, like I said, is the omnibus provision because it covers every type of situation under which your refund could arise. When we come to 142, 4 and 5, you'll see that those deal with specific situations. 142, 3 deals with the general situation. Now, what 142, 3 goes on to say is that the amount that is applied for refund by you shall be paid in cash, notwithstanding anything to the contrary, except the provisions on unjust enrichment, which is under section 11B2. Now, why the need for the non-obstante provision is that this could also cover a situation where you've wrongly reversed SENVAT credit. And wrongly reversed SENVAT credit, for example, is a case where you will not get back a refund in cash because that gets reinstated to your SENVAT account. But in this situation where after you made a wrong payment, when that reversal needs to happen, because you've migrated over to GST, that amount will be given to you as a refund. Therefore, it says that notwithstanding any of the restrictions on giving you a refund in cash, you will get a refund in cash. This still stays subject to the provisions on unjust enrichment, which means, of course, that the amount will be credited to the Consumer Welfare Fund, subject to us being able to evidence that the burden of this duty has been borne by the person filing the refund claim. Now, if the claim for refund is rejected, the amount lapses. What this means, this doesn't, of course, take away our right to go and appeal, saying that this refund has been wrongly rejected, but the provision needed to bring in finality in terms of what's the status of the refund claim. So either you get your refund in cash, and that's how the matter ends, or you might go in appeal, and then depending on what the appellate authority will decide will determine the outcome. But failing remedy at the appellate level, they had to bring closure to the fact of your claim for refund. The refund has to lapse. What would have been the contraposition? The contraposition would have been that there would be a recredit to the credit ledger. But that's not possible because we've now moved over to GST, and therefore the need for this provision. It then says no refund shall be allowed of any SENVAT where the balance has been taken as credit. So that goes without saying. In fact, I think what 1.5 years back they amended, I think, by that notification which said that when you file a refund claim, you need to debit your SENVAT account to that extent, because otherwise we used to have these SENVAT claims lying pending, and at the same time we had the amount reflecting in SENVAT. So if that situation exists for anybody in their books, then this provision blocks that, saying that to the extent you've applied for credit takeover or carryover under 141, you cannot be eligible for a refund. Here again, the same provision under the SGST Act as well. Then we come to 142.4. And like I said, that was the omnibus case. This is a more specific case which deals with refunds in a situation of export of either goods or services. And it says that if you filed your claim, and here we come to the situation of after, that if you file your refund claim after the appointed date in respect of tax paid under the earlier law, it shall be disposed of under the earlier law. So 142.3 covered on, before, or after. 142.4 covers only after. It's a little unclear why that is. I was thinking it might as well have said all of them could have actually said irrespective of when you filed the claim, because this claim also would be liable to the same principles, but they've currently said that it only applies to claims filed after. Again here, if your claim is rejected, it lapses, and no refund is available if you've taken SENVAT credit under 141. Now, the difference between the situation of 142.3 and 142.4, which carries from the current SENVAT treatment as well, is that the unjust enrichment rule has not been incorporated here, because when it comes to exports, the unjust enrichment rule doesn't apply. So we don't have the 11B restriction insofar as refunds of exported goods and exported services are concerned, like it is under the current rebate provisions. Then we come to the situation of refunds dealing with services where the service was not provided. Now, this comes almost out of Rule 6 of our service tax rules currently, where if you have a situation where you've charged service tax, collected the service tax and deposited, for one or the other reason the service is not provided, and that amount then you're supposed to get refunded, that amount in a typical, in a usual sense would have been credited back to the Senvat account. Here, of course, it says that the amount will be paid back to you in cash because the situation of crediting it back to the account does not arise. So under 6.3, you had an automatic write back. Here, the question of the automatic write back doesn't arise. The state provisions again have a similar provision to 142.5. What we have in two states, which is Gujarat and Rajasthan, have a specific provision which says any amount of ITC reverse. So they've actually taken a provision out of their SGST law and put it, on the state VAT law and put it here, saying any reversal of ITC prior to the appointed date shall not be admissible. So when you compare line by line, the 142.5, of course, they don't have this part of 142.5 because they don't deal with this provision, but they deal with a provision talking about ITC reversal under the VAT law. And Telangana, for some reason, doesn't have a 142.5 equivalent provision. So those were the three situations of refunds. Like I said, I just want to highlight you two differences. The situation dealing with export of services didn't have the unjust enrichment requirement, and the situation dealing with services not provided didn't have the write back of credit requirement. So that's the subtle change between those two. We then deal with situations of claims against us, claims made by us under the current law. So there's sort of two sets of provisions to discuss here. I'll just read the first one. The first one deals with a claim for Senvat, and the second one deals with recovery of Senvat. So it says, if there's a proceeding of appeal, review, or reference relating to a Senvat claim made before, on, or after the appointed date, it shall be disposed of under the current law. So it basically says your current ongoing litigation will be under the current law. Any amount that is found payable to you, and here again we have that same provision which we saw in refunds, any amount found payable to the claimant will be paid in cash because there's no Senvat to reclaim, again subject to the provisions of unjust enrichment. And here a distinction is made between a refund situation, which like I said is under this act and paid in cash. If it's a demand, on the other hand, as opposed to a refund, then that payment is to be made under the new law, meaning the demand is made under the GST law and no credit is eligible of the amount charged under the GST law. So while the provisions is almost a mirror image of each other, this is the important change, that refunds are under the old law, collections are under the new law. Refunds, you don't get credit because you claimed a refund, and demands you don't get credit because that's a restriction on credit availment under the new law. Similarly, 142.7 deals with proceedings. So 142.6 and 142.7 are almost identical. The only difference is that 142.6 deals with Senvat issues only because there are separate provisions under the Senvat credit rules for Senvat disputes, whereas 142.7 deals with, on a more general basis, proceedings relating to output tax duty and output liability. So here again it says, if as a result of your appeal, review, or reference, if you're eligible for a refund, you'll get that refund under the old law. If a demand is made against you, that demand will be processed under the new law. Likewise, under 142.8, again we have a very similar provision. 142.8 deals with assessment and adjudication proceedings. So those were appellate and review revision proceedings, Senvat, general, and now we come to assessment and adjudication proceedings. Here again, amounts recoverable are under the new law, amounts refundable are under the old law. 142.9 deals with the situation of a revision of returns and says that where a return furnished under the law, the earlier law is revised under GST, if pursuant to that revision an amount is recoverable by you, again it gets recovered under the new law. Conversely, if under the revised return you're eligible for a refund, you'll get that refund under the old law. that refund will be subject to the unjust enrichment provision. That refund will be subject to you not having availed credit. So you see a lot of similarity between all of these adjudication, appeal, and carry forward provisions with this one theme in them. 142.10 is another section to spend a couple of minutes on. That deals with situations of goods or services supplied after the appointed date in pursuance of a contract entered into prior to the appointed date. Now, this is your typical situation of long-term contracts. It could deal with, therefore, continuous contracts, what we've been calling continuous contracts under service tax. It could deal with actually a wide variety of business situations. So, let's take real estate as one example, where we've had, you all know the service tax and VAT situations which have existed from the real estate space in terms of the fact that you have different tax events, in fact, currently. Of course, we should come back to real estate separately because there's a very interesting provisions under 142.12. But let me take a simpler example of, let's say, a AMC contract, where under an AMC contract, you might have paid upfront for the entire amount. Part of the goods and services may be provided under GST, but both your taxing events have taken place under the earlier law, and there you actually don't have to pay GST because your taxing events are over. Contrast that with a situation of, let's say, a manpower supply contract, where on a monthly basis, based on the number of workers that are deputed, etc., you will have a monthly billing. So you might have had an annual contract where 6 months of the contract were under service tax law, where you charged your service tax. For the remaining 6 months, where you make your monthly bills, those supplies will be under GST. Now, not only do we need to look at long-term contracts and work contracts from this point of view, we also have to look at sometimes the treatment of long-term contracts in terms of the lead time that sometimes might go into when you procure. Let's take you're setting up a plant or a turnkey type, machinery erection installation type contract, where you might actually have a situation, and this deals not only with 142.10 but some of the other credit-related provisions that I was talking about, where you might have to make procurements today under the current law to make a supply which will take place under GST. And that's where certain planning opportunities or risks may arise in terms of your eligibility of taking credit or not taking credit, because if you make those purchases today, your eligibility for credit will be dictated by today's provisions, even though you're actually fulfilling a contract where your output tax liability when you fulfill the output side will be paid under GST. Not only this type of long-term contracts, in fact, we were dealing with a couple of people who actually had a simple movement from a non-taxable, a currently exempt stream of business which is related to textiles, where today they are in a non-taxable schema, and going forward they're going to overnight become taxable. And the question is in terms of how to ensure the maximum amount of credit available. And this is where what we've been reading about in the paper saying, not just from a long-term contracts point of view, but even from a larger supply chain and supply planning point of view, these issues in terms of the correlation between taxability and point of taxation is going to become quite important. So to what extent do you apply our POT rules as we have them under service tax, and to what extent the the time of supply rules in GST will override those provisions. Then we have the concept of a continuous or periodic supply. Now, this is possibly the most benevolent provision that I thought there was in the carryover provisions. This says that notwithstanding anything contained in section 12, which is the time of supply rule for goods, no tax shall be payable on goods to the extent that tax has been levied under the VAT Act of the state. Now, two comments here. I don't know why the central GST law talked about the VAT Act of the state, because we checked with the state GST laws and there they said VAT Act of the state, and that made eminent sense. But here, perhaps it ought to have said Central Excise Act. Perhaps I'm just thinking more deeply about why this has been worded so. But what 142.11 is basically saying is that in a supply, in a continuous supply, if your tax has been paid, and the wording there is to the extent that tax was leviable. And when you actually start researching what the implication of this are, a lot of questions will come up. Does leviable mean excisable versus non-excisable? Does exempt continue to mean leviable, and so on? But the plain reading seems to be that to the extent that tax was leviable should simply mean that if a certain amount of tax has been paid, To the extent of that tax, you don't have to pay any tax under GST. Likewise, notwithstanding anything contained in section 30, no tax shall be payable on services to the extent tax is being paid on services under service tax. So this is where the 142.11 provisions actually also coalesce with the 142.10 provisions on long-term contracts. This is the reason I mentioned over there, that we have to make a distinction between when your time of supply is triggered and when the service is provided. Because depending on that, you'll actually have to decide whether part of the service is liable to GST or the entirety of the service continues to be under service tax. The last part of 142.11 deals with probably the most interesting situation, which is where tax was paid on any supply under VAT and under Chapter 5 of the Finance Act, which means where you've paid both taxes, it says that tax shall be levied under this act, and the taxable person shall be eligible to take credit of VAT and service tax to the extent of supplies made after the appointed day. Now, what this seems to be therefore saying is that we don't want a situation of double taxation. We know that there's been a situation of double taxation, and therefore what we'll do is, to the extent of VAT and service tax paid, instead of saying you won't pay that tax, we're saying we'll give you credit of that tax and charge tax on the transaction under GST for supplies made after that date. So there's a difference between how 142.11 Part C applies versus how it applies for the transition provisions under 12 and 30 under goods and services in the normal course. Then we deal with goods sent on approval basis. Again, dealing with that situation where goods have been sent out before and goods may or may not have come back after GST. Very similar to the provisions that we had under 142.1, which talked about sales return. So there also we had a 6-month time limit saying that the goods should have been sent out within the last 6 months before the switchover. Here too, the goods should have been sent out within 6 months before the switchover. If they are rejected or not approved and returned after, within a period of 6 months, and that period of 6 months may be extended by a further period of 2 months, no tax gets payable in that situation. And then when you eventually sell the goods again, you will pay GST. So today you've paid VAT. Today you've not paid any tax. The goods are out. You didn't pay tax because your tax event had not crystallized. If the goods come back within 6 months, you continue to not pay any tax. But if the goods are returned after the period of 6 months, then tax becomes payable by the person returning the goods. So your supply to him, while it remains non-taxable, the supply by him returning the goods to you becomes a taxable supply. And conversely, tax is payable by you if the goods are not returned within 6 months. The assumption therein being that the goods have actually been sold. So if the goods have been sold, then you pay tax at the end of 6 months on a presumption that the tax event has crystallized. 142.13 deals with TDS, which states that where a supplier has made any sale transaction, which largely deals with works contract where TDS provisions apply under the state VAT law. If TDS was required to be deducted under the state VAT law, where your invoice was issued before but payment is made after, then notwithstanding that it would have been liable to TDS under the existing provision, which is at the time of invoicing, no deduction is required under GST. So that deals with that time gap between the issuance date and the payment date and disables the need for a withholding of tax. And finally, we have the situation of goods lying with an agent. Now, this is not in the Central GST Act. This is there in the state GST laws. And this links to the concept of deemed supply, which we have under Schedule 1, where it talks about transactions that take place through an agent, where it says that the transaction through an agent is deemed to be a supply from principal to agent. So this provision says that where any goods or capital goods belonging to a principal lying at the agent becomes eligible to take the credit of those goods. Again, subject to some conditions. So he is a registered person. There's a declaration to be filed by both parties saying that this is the amount of stock lying with him. Invoice should be 12 months old. And the principal should have reversed the credit to the extent that the credit is going to be taken by the vendor. So notice how similar in a sense this is to the 141 provision that we started with, saying that if this was my transition credit, I would have taken the credit. Here, this actually shifts over the availment of credit by the original owner of the goods to the agent of those goods. And that's simply because under the Schedule 1 entry, when when the agent makes the supply on behalf of the owner, that's going to be treated as a supply by him. So this actually syncs up with that. So that's the overview of the 4 sections that we have in transition. And I think we can take questions.
We have got time for a few questions, but you wait for the mic to reach you before you ask the question. These provisions are actually terribly complicated, horribly complicated in a sense, but Udayan made it quite lucid in the way he has really summarized all the or dissected all the provisions. So, can I have the first question? Yeah.
My question is regarding that the condition of that person should have filed the return for last 6 months. Now, many people owing to credit availability have taken the registration in recent past, and they may not have been able to file the return for 6. Be it a trader, like traders are required to file return only on quarterly basis. So maybe 1 quarter they might have filed the return. So how it will be treated under the transition for those people?
So that's a good question. Currently the state provision doesn't make any. You're talking about a 141 situation.
Yeah.
So currently the state provision doesn't make any distinction between a monthly filing dealer and a quarterly filing dealer. So possibly we can.
I'm talking about the central excise return. People have taken registration as depot or a importer, first state dealer, second state dealer,
Right.
and in last 2 to 3 months, then they will not be filing the return for 6 months, because anyway those people are required to file return on a quarterly basis.
So the first stage dealer, second stage dealer situation comes under 143, which doesn't have that 6-month filing provision. Yeah, the 6-month filing provision is under 141. The first stage dealer, second stage dealer, registered importer are under 143.
Hello. Sir, this is related to section 143.
Yes, sir.
Yeah, this is related to 143. So, in case of purchase made from the depot of the manufacturer, whether that depot, the purchase invoice issued by depot will be considered as an excise duty payable invoice, he will be eligible for 100%, or it will be goes for that 40% case?
So is that depot registered as a first stage dealer?
Yes.
So then you can go on the basis of the 100% credit.
Because the invoice which is issued by the depot stating is a duty paid invoice.
Exactly. So that's exactly the situation which people want to be in, where if my depots are registered for excise purposes, for passing on of excise credit, then, well, even if they weren't, so long as they are registered, so long as they are holding duty paid invoices, they can take the credit of the stock that they are holding.
Okay.
The invoices that they issue downstream, if those are excise paid invoices, even the downstream person will be able to take credit.
But the invoice which is issued by the manufacturer, which is factory, which is not similar with the invoice issued from the depot. So whether that will come under Rule 9?
No, how do you mean it's not the same as the issued? Actually,
because
the same duty paid by the factory has been passed on from the depot. So they will be maintaining a register of goods coming in, the duty on those goods, and the duty passed on when the goods goes out.
Correct.
So the invoices being raised from the depot will reflect the same duty that came from the factory.
Yes, it is reflecting. So I mean to say whether that depot invoice will be covered under the prescribed document which is mentioned in 143.
Yes.
Yeah. Okay, thanks.
So I'm availing CENVAT on payment basis, meaning whenever I make the payment to the vendor, I'm availing credit. So now, under the current law,
Service provider?
I'm a service provider. I have a creditors of more than 6 months. So I cannot avail SENVAT because 3 months have already lapsed. Under the current provisions, I
Right.
cannot avail SENVAT. So how will I carry forward in my GST?
No, sorry, can you repeat the question? You've not paid your,
I have not made the
Your
payment to the
creditor
vendor
was-
for more than 3 months.
okay,
Okay. So I cannot avail SENVAT under the current law.
right.
So how will I carry forward that SENVAT in my GST?
So your 3 months have already completed,
Yes, I have a creditor of more than 3 months.
but then it might be, you should actually make sure that you pay before the switchover date and take the credit. Don't migrate the unpaid amount over into GST. Pay the amount before GST happens and take the credit on payment basis.
The credit will lapse.
Well, it doesn't say so explicitly, but there's a high chance of that.
Hello.
I'll just confirm that. See, it says that the credit has been reversed. Well, it might be arguable to say that this credit comes back to life, but I think that that seems a little iffy. I think it would be safer to just pay it off and take the credit and migrate over the availed credit.
Yeah, hello. Sir, what would be the treatment which you told that in respect of long-term contracts and works contract for real estate and construction business going on? So how it needs to take it basically? Because you might be seeing that the projects goes for at least 3 years, 2 years basically. So how it needs to be taken?
So we largely follow the sort of methodology which is being followed currently for VAT and service tax purposes, which is that all supplies which take place after the GST switchover date will be liable to GST. Whatever you've paid just now will be under service tax, and that will end that way. So let's say all of us who are flat buyers in houses which are under construction, part of the amounts that we all that we paying after that will be liable to GST.
Yeah, may I take the relative question? See, I am a works contractor, and on the transition date, I have a lot of cement and reinforcement. These are the excise paid material at my project site.
Correct.
So, can I take the credit of that?
Yes, so under 143 you can. So long as you fulfill those conditions which we talked about, the conditions under 143. So today you're taking the 20. Are you taking 26 or 12? Or you're taking 2A.
I pay the service tax only on service portions. On goods portion, I only pay the VAT. Now, question of excise duty on such cement and steel.
Yeah. So you will be able to take the credit so long as you have the invoice and so on. You will be able to carry over that credit which you're holding.
That project site is only covered in service tax, and so the question is of central excise. How do I push it to my return?
No, that's fine. But this specifically provides for 143. Specifically provides for your kind of case.
Fine. Thank you.
Sir, in case of a
Question is regarding 142 2B, where the price is reduced afterwards in GST regime. So if the supply is made to unregistered person, then because the provision says that the customer has to reduce its input tax credit. So if it is supplied to unregistered person, then what is the scenario? Whether I'll be able to reduce my tax liability in GST regime or not.
So that links to the larger question of even in the normal costs, not only transition provisions, but for credit notes, whether you can. There's one view is that yes, you can because nobody is taking credit of the downstream. So doing a back working by treating it as an inclusive, that's one view, that you can reduce your output liability.
sir, excuse me. In case of 143, sir, a trader who purchases, for example, garments, in the current structure, the excise is paid based on some MRP-based abatement. So, will that be considered as a duty-paid document, and the whole of excise can be taken by the trader?
But do you have an excise invoice for that MRP? I mean,
Yeah.
MRP you have.
Yeah.
That's fine. So, however, whether it's assessable value or MRP based, so long as you're holding a Rule 9 document, you're okay.
So in that case, the 100% excise will be possible.
Yes.
But if I am not having that document and I am taking it from a trader,
Yes.
and I am a third stage trader, then it will be a 40% rule, whichever comes.
But that 40% rule is subject to you're passing on that benefit also. Huh?
Okay. Okay.
Yeah. And also 40% of output liability.
Sir, with respect to unavailed credit of capital goods,
Yes.
so when can we claim the credit? Whether on the appointed date itself or on the 1st April 2018?
No, on the appointed date itself. There is no.
So
This is migration of credit. So now this 50% restriction which we currently have under Rule 4 is gone.
Okay, so we can claim the entire credit
Yes.
in the financial year 17-18 itself.
Yes.
Okay. And one more thing, whether a person who is not liable to be registered under any of the existing law, can he also claim credit of capital assets by virtue of this provision?
No, so one of our conditions for availment of capital goods credit was that you should be eligible for credit today and tomorrow. So you will
Okay.
fail that test of being eligible today.
Okay. There is a wording, there is a difference in wording. In many sections it is saying admissible, and in other many sections it is saying eligible. So what will be the purpose of it?
No, I think that's just language. I
Okay.
haven't
Okay.
accorded any significance to those.
Okay, sir.
This question is with regard to section 142(5).
Yes.
Suppose in June, I discharge my service tax liability along with service tax, KKC and SBC. And after that, on GST scenario, I raise a credit note. So since the provision says that I will be eligible for refund, so whether I will be eligible for SBC refund also?
142.5.
Yeah, 142(5). Services not provided.
Yeah, you should be able. Yeah, it should be that the current reinstatement of current under 6.3 you get back SPC KKC also, right?
Because the whole point is that whether or not that tax is due to the government, that's the first part. The reason why they give it back to you is because when the taxable event, that is the provision of service itself, has not happened. What they have done is that they have collected the tax ahead. But the taxable event has not happened, so they have no right to retain it. The way they used to give it back was a credit. Now, considering that you will have no SENVAT credit account remaining, they have to give it to you back in cash.
So, this is regarding 142(2), where I issue an invoice in the existing law, say a service invoice, where I have levied 15%, and then in the after the appointed date, I issue a credit note or a debit note. Accordingly, I have to proportionately reverse my taxes also. So it will be service tax rate or the GST rate, because the credit note is under the new law. So which rate I have to reverse? Is the 15% one or the 18%, for example?
It's be the GST rate.
GST rate.
Yeah.
Okay.
Because it's treated, this transaction is treated as, the adjustment transactions treated as taking place
In the current
in the GST regime.
era. Okay.
Sir, in GST provision, transition provision, that is a SENVAT credit, taken as a credit, ITC, as a CGST. In case of branch transfer, that is reversal of the credit is not allowed as of this one. Can you explain that one?
Sorry, sir, could you please repeat the question? We couldn't hear you too well. If you could speak into the mic, please.
In case of, that is a SENVAT credit is going to be transferred in transition provision as a CGST credit. But in case of VAT, if there is any branch transfer reversal, it is not allowed. Can you explain that one again?
So, you see, as far as the credit carryover is concerned,
Yes.
there's a parallel provision under the CGST provisions and the SGST provisions. The SGST provision has an additional requirement beyond the 5 conditions under the CGST law, which says that wherever forms are involved, so those 5 transactions where there is a reduction in how much tax you pay to the origin state, stock transfers being one of those cases, you have to issue those F forms to that, means collect those F forms and file them within a period of 3 months after the switchover for your credit not to be affected.
But in case of this one, but there is no credit transferred, but there is no reversal. Reversal in excise duty only. But excise duty has credit available in that is CGST credit. How is it possible?
No, you're talking about, sir, I'm saying if you want, CGST is not affected by this part. I'm saying if you want to migrate all of your SGST credit, then to the extent that forms are due to the origin state, you need to file those forms. Because when you took a certain tax treatment in the origin state, so you would have applied some retention, you would have applied some non-payment of tax. So F form you would have not paid tax, for example. You might have had some retention, that's a separate thing. So, but you've not paid tax. If you don't if you don't issue the form, that gets treated as a CST sale. That's the provision of the CST Act. So I'm saying in the spirit of fulfillment of those conditions, what the SGST Act has provided is that for your full credit to be eligible, you need to give those forms.
This Form F,
Form F is required to be given.
Last 2 questions.
This is regarding the proviso to subsection 3, which specifically says, including the said taxable person shall pass on the benefit of such credit by way of reduced price to the recipient. If you envisage any situation, I would say this situation only thinks it can be covered is when there is an MRP or there is a loss, because otherwise what is my selling price cannot be determined in any other way, because it would include cost plus margin. So if anyway otherwise...
Where is the person asking? Yes, sir. Sorry.
So my view is, this is workable if I make a loss to the extent of 40%, or it is a product which has an MRP.
So as I said, the methodology, we have a couple of ideas in terms of how this passing over is going to happen. Like I told you, there's a circular. The minute you reduce the price, your base amount changes and so on. So I think we'll have to wait to see what computation rule they come up with. But you're quite right. Largely, a price reduction will only become reflected if it's an MRP item. But in most cases, the people who will come under 3 will not be at the MRP stage. They will be somewhere along the supply chain. So we'll actually have to wait to see what valuation rule they prescribe for this.
MRP or loss. If I make a list, then it is easy to prove that this much of portion I have run. There are the only 2 situations I can have. Even if they come with a computation, it would be very difficult to say that, because what is my margin itself will become a question mark.
No, you won't come to a loss. Let's take a simple numerical example. I'm saying if you buy at, let us say 100, and you paid VAT on that purchase. I'm taking that sort of example, okay? Excise on that purchase. When you apply that 40%, first of all, we have to know what 40% you're applying it on. Is it on 28, as we said before? Is it on 28, is it on 18, or is it on 12? That's going to actually dictate how much deemed credit you're actually getting. Okay, so potentially you could have bought 6% items and you're going to get 40% of 28. I'm just saying, I'm taking a very extreme type scenario. So you're actually talking about getting more credit there. But if you take a simplistic example, what will happen today is, compare your today's situation with your tomorrow's situation. Today your excise sits as part of your cost. So your cost of purchase is 112.5 and your selling price is whatever it is. Tomorrow, that 112.5 stands reduced to the extent of credit you get. Likewise, your selling price stands reduced by the same amount, because to the extent that you're taking credit, you're reducing your selling price. So if you apply it as a linear formula, your P&L effect is neutral. But there are many more things which will play out in this, which is why I'm saying we'll have to... So fundamentally, it's going to be a function of what rate it is. But if you simply do a pass-through, then there will be no P&L effect, because your price reduction, your P&L debit of purchase price goes down to the exact extent that your selling price goes down.
In the case of registered importer,
Yes,
where the import duty has been paid using a DPP license, would the amount of duty be available for credit, or only the cash component will be available for credit?
No, so there are judgments to say that payments through DEPB are equivalent to payments in cash. So I don't think there should be any restriction there.
The duty paying document would show only 0 as the duty. You know, the bill of entry.
No, it doesn't.
Zero.
It won't show 0. It will show the amount paid. It's just discharged through a DEPB.
Bill of entry actually shows the duty as 0 when you use a DEPB. The bill of entry will always show 0.
Let me get back to you on that. My impression, I mean, I know there is sufficient case law to say that DEPB amounts to payments of duty and therefore credit has been allowed. So by the same token, it should be. I'll check on this bill of entry thing, but there's no reason why your credit should be denied.
Thank you very much. We have, by the way, Bombay Chartered Accountants Society has been accredited GST trainer by NACAN, and we have got 10 certified NACAN GST trainers. The first batch has already been announced and is already full. The 3-day course, and that is on the 29th, 30th and 31st of this month, is already full. The second batch has not been announced. It is on the 19th, 20th, 21st of June. So I would request everyone who is present here, who is viewing online, to please enroll as soon as possible, because the batches are getting full very fast. And as you have all seen, that the topic is really complicated. This is only one set of provision that we are dealing with today, and we'll have one more round of another topic, maybe by this month end, or maybe in the first week of June on GSTN. So let's hope that we get more and more speakers, expert speakers like Udayan, to explain us and take us through all these complicated provisions. I request Samir to make a few announcements and do the honors. Thank you. Just wait for 2 minutes, please. Just only 2 minutes more. Thank you.
Couple of announcements. We have the next lecture meeting on the 6th of June at the KC College Auditorium. The topic is filing of income tax returns for the assessment year 17-18. The speakers are going to be CA Bhadresh Doshi and Akshata Kothari. Apart from this, we have 2 full-day seminars organized on the topic of Income Computation and Disclosure Standards, ICDS. The program is on 19th of May. It is going to be held at Naveen Bhai Thakkar Hall, Vilepale. The next program is full-day seminar on TDS. This program will be held at the IMC Walchand Hirachand Hall. Apart from this, BCS is also organizing Tarang 2017. This is an annual day for the students. I'm sure you would know that the exams are now over. You can sponsor your students and article clerks for this program. This will be very, very helpful and useful to them. I would suggest that you encourage all of them. Coming to the honorable task of proposing a vote of thanks. I'm sure all of you would agree that the transition provisions are a set of very, very complex provisions, and when you go to read them threadbare, they are like a maze that you can get lost in. But Udayan, with his very, very lucid examples and explanation, carried us through this maze and has shown us the path to avail the credits and to take benefit of these provisions. What one must appreciate is that he has taken his time and he has shared certain valuable nuggets from his experience dealing with clients and dealing with live situations. We are very, very thankful to Udayan for that. And for this, I would, on behalf of BCS, propose a very well-deserved and hearty vote of thanks and request you to carry out a round of applause. Thank you.
The guest speaker for the students' annual day is a 32-year-old student from NM College who is a Guinness Book of World Record, Mr. Dhaval Bhatia, who will excite everybody in his half-an-hour speech that day. So I request all those members to sponsor their students for this annual day on 3rd of June. Thank you.